Hello, how's everybody doing? If you could give me a thumbs up in the chat, let me know you can hear me. We'll get started here in a couple minutes. All right, we'll get going here in about one more minute. Appreciate everybody hopping on. Again, if you guys can hear me, give me a thumbs up. Perfect. All right. I know everybody's probably pretty busy. Thank you for joining. I'm going to try to keep this down to about 30 minutes to go over a pretty unique opportunity that we have over at Rising Phoenix Capital. It's part of our growth strategy called the Rising Phoenix JASPO drilling opportunity, and I'll go into kind of the naming behind that. But first and foremost, I just want to thank you guys for taking the time out of your day. I know everyone's busy, so I'll do my best to get through this, do a little training or education on what this type of oil and gas drilling opportunity is, what the development plan looks like, return profile. We've got some great tax savings investing into a non-op drilling opportunity like JASPO. And then I'll open up for some questions and answers. So if you have any questions, feel free to just drop them into the chat and I can kind of jump on those towards the end of the presentation. So again, thanks for joining us and we'll get going. So kind of stepping in, disclaimer, obviously I'm not a tax professional, and but I do know some things about, taxes and ways that you can save, but just a little disclaimer here, as you see in most of these types of webinars. Anyway, so we'll jump right in, talk about kind of some of the upside potential with a drilling opportunity. Again, this is kind of a unique asset that most folks don't have access to, these types of direct drilling deals. And so I'm excited to roll this JASPO opportunity out to our investor base. They've been asking, and so now here we are with the first of many offerings in this growth strategy. So we'll just step through. I'll give a little bit of background on Rising Phoenix Capital, who we are, what we do. A little bit of background on oil and gas drilling funds. Again, I've got a lot of background and history on these. My old man, Jim Graham, built his career out of this for over 40 years in the oil and gas business, is putting these types of opportunities together. So when I worked with him, we did numerous amounts of these with our investor base. And so I'm excited to kind of roll this one out to our current investor base. We'll talk about the JASPO Non-Op Drilling Fund, and then I'll give some investment highlights, tax advantages, ways to invest in this type of offering, and then kind of open it up for some Q&A. And like I said, I think we can get through this in probably 30 minutes. It's not overly complicated. Like my old man always said, if you can't explain it on the back of a paper napkin, it's too complicated to invest in. So we try to bring that to our investor base. And if I can't explain this thing on a paper napkin, then obviously it's too complicated for you guys to invest in. So, but I do want to kind of set some foundations on kind of what this opportunity is and kind of how it compares to kind of our income strategy, which is oil and gas minerals, producing oil and gas minerals. And then we'll talk a little bit about a new strategy that we're rolling out in 2024, our debt strategy. So a little bit about Rising Phoenix Capital. Rising Phoenix was founded in 2015, focusing in on kind of oil and gas investing, oil and gas minerals. We do direct investing into oil and gas drilling deals like this. We've got a real estate acquisition team that does anywhere from 100 to 120 single family flips a year, whether that's fix and flip, wholesale. We do seller financing where we carry mortgages. We do hard money. And then Rising Phoenix Capital is a fairly new arm, which is going to be dedicated solely into working directly with our unique investor base to bring these types of offerings to our platform. So our mission, we want to empower our investors to access inner circle deals. So like this JASPO deal, the operator that brought us the deal, Atoka, about 40 years in the business. And this is kind of a drilling deal that typically sells out within kind of an inner circle of oil and gas professionals. So I'd like to kind of take that's being brought to us and kind of bring this out to our investor base. Our track record, we've got over a decade of success at Rising Phoenix, even more so if you look at kind of my experience back with our family's company, Palo Petroleum, that was founded in 1976. We leverage 4 generations. I'm a 4th generation oil and gas professional. My great granddad sold a dry goods store in Muskogee, Oklahoma for drill and pipe, a trailer drill and pipe, and moved to Tyler, Texas, and started a career down there. And my dad was in the business and very influential. I grew up on a rig with him doing drilling deals. It was a blast as a kid, going out to West Texas and all the different places that we had projects going on, Four Corners, Colorado, up around Durango and whatnot. So I've been around this stuff for quite some time, and just excited to be bringing this out to our investors. Strategies, we've got 3 strategies now. In the past, we were just kind of doing the income strategy, which was producing oil and gas minerals. Great strategy, very, I'd say, on the spectrum of riskiest to safest, the safest of oil and gas investing. Going out and identifying opportunistic producing mineral funds throughout the country. We have a team here. They're actually on the phone now, calling prospective mineral owners throughout the country, seeing if they'd be interested in an all-cash offer. But rolling out this growth strategy, again, very knowledgeable in kind of what these things are and how to underwrite them. And I think our team has done a phenomenal job of really looking into this deal and seeing, the mechanics, how it works, looking for the Achilles heel, and it passed mustard. So we're excited to bring this out. And then of course in 2024 we're going to be rolling out a debt strategy, which is more of a fixed return profile, anywhere from 8 to 12%, depending how long your capital is in play. So Rising Phoenix Capital is a dedicated team now that's going to be the other Rising Phoenix verticals are creating opportunities that Rising Phoenix Capital will be raising capital to invest in. So again, just a little background, just kind of dipping into these different strategies to kind of explain those. Income strategy, again, that's kind of middle of the fairway. We're buying oil and gas producing minerals. We've got about pushing 30 million of assets under management on this strategy, and it's kind of our bread and butter. And we're really good at it. And so again, we're calling lots of mineral owners throughout the United States and trying to negotiate a lump sum cash payout for their monthly ongoing royalty revenue. Next fund's opening up in October. It's called Maroon Bells. Very excited to be rolling that out. Probably late October is when it's going to come out. Capital Peak was the last fund we did. I'm starting to name these funds after 14ers in Colorado that I've climbed. So Maroon Bells is the next, followed by La Plata. I'm running out of names, so I need to go climb some more mountains, I guess. But anyway, so next fund's rolling out in October. You'll be receiving some information on that in the coming weeks. And it's really focused on monthly cash flow. We are buying producing minerals. And so the exploration and development has kind of been taken out. We can look at the producing minerals, fit a decline curve using our reservoir engineering firm, and kind of forecast out what we think that is worth, and then make an offer to a mineral owner. This strategy, we're looking at about a 1.5 to 2 to 1 return, total return. That's including the monthly payouts or monthly royalty checks that you receive. So if you invest 100,000 within a 2 to 4 year period, depending on timing and when we sell, we expect to deliver back 150 to 200,000 in return. 20% internal rates of return there, and there's a 15% tax depletion allowance on that. Meaning that if we distribute, or on your K1 shows $10,000 in royalty income distributed, you're only paying tax on $8,500. So you get a little bit of tax break there. A lot of folks use their self-directed IRA to invest in this type of strategy. Growth strategy, this is the one we're here for today to talk about, which is JASPO. Really excited to be rolling this one out. This guy is more of a 3 to 4 to 1 return. And so we're going to kind of step into what that looks like. Internal rates, above 50% is what we're looking at here. And then this thing has got a phenomenal write-off, tax write-off of up to 75%. Again, kind of depends on the IDCs. I'll explain this a little bit more. The intangible drilling costs, which is the drilling rig to drill the wells and whatnot. We can write off that capital expenditure in the first year. And so typically it's anywhere from 70 to 80%, depending on what the operator sends us. So that's a phenomenal tax write-off on ordinary income. So and we'll talk more about that. And then finally, the debt strategy. Again, using minerals that we own, not in the fund, but actually minerals that we own, Rising Phoenix owns, as well as real estate notes, mortgages, private mortgages that we also own, and utilizing those as collateral, and then just basically paying an 8 to 12% preferred rate of return based on timing of capital. So if you're in for maybe a year, it's 8%. If you want your money in play for a longer term, it's going to be a higher interest rate. So excited to be rolling that out. So again, 3 strategies covering from one end of the spectrum to the other, depending on, risk reward profile. So let's step in just a little bit. Let's talk about what the JASPO drilling deal is. And I know I've got some people on the phone that are on the webinar that know about oil and gas drilling. I've got some very seasoned investors with us in this deal already, but I also have some people on the phone that maybe have never even heard of this stuff and really don't understand the mechanics and how it works. So I figured I'd just kind of step in and explain a little bit about the conventional drilling. So before the shale plays, which are known throughout the United States now, which is the horizontal drilling that you see on the little pump jack to the right, all we did was do conventional drilling, which was drilling vertical wells down into a reservoir and utilizing the formation pressure to push the oil and or natural gas up to the surface. When that pressure kind of subsided, then they would put a pump jack on it and it would help lift that oil or natural gas out. This opportunity, the JASPO opportunity, is a conventional drilling deal, which, there's a lot of positives that come out of them. Again, we're not horizontally drilling and fracking. I know fracking is kind of a bad word these days. Again, it's, technology that's utilized to provide us with a lot of the luxuries that we have as United States citizens, which, abundance of energy and power and whatnot. So, but this deal is a vertical drilling deal, like you see on the left, where we are finding a pocket of oil and natural gas. In this case, it's about a 50-50 mix between oil and natural gas. So it will look very much like this picture where you've got kind of natural gas that kind of rises to the top and then oil below. So we'll be producing out of the wells, or I should say Atoka will be producing oil and natural gas and selling both of those commodity types each month to the end buyer. Just a few things to think about here. You're drilling down, the formation is anywhere from the Yewal, which is what we're going after, is anywhere from, I'd say, about 11,000 to 12,000 feet vertical. So we're deep. We're mile plus deep below the surface, and so there's no fracking, there's no hydraulic. There's a lot of formation pressure underneath that deep that's going to kind of push that oil and natural gas to the surface, goes to a tank battery for oil, natural gas goes straight to a pipeline, and then it's sold. And then the operator and us as also an investor receives a monthly check that we will then turn around and distribute back to our investors. So again, this is a conventional deal, vertical wells. We've got targeted reservoirs. There's a lot of data points that Atoka has utilized, additional wells that have been drilled in the area. It's a very prolific area that has a lot of data points on where they were able to kind of identify the best two positions to place the first two wells. So let's get to it. Let's talk JASPO. That's what everybody's here for. Again, I appreciate you guys taking the time. So the JASPO drilling opportunity is really we're involved in the partnership Rising Phoenix JASPO Development LLC, which is what everybody's investing into, is part of a 40 square mile 3D seismic. So it's the AMI. So we as the partnership have got an AMI over 40 square miles. So even though this project is 2 wells, and I know some of the folks that are on the call, when we initially started, it was 3 wells. There's still going to be 3 wells that are drilled, but right now the project itself, the scope is going to be 2, and then we're going to have the right of first refusal to invest in the 3rd well. That doesn't really change anything as far as the economics. In fact, it gets a little better because there's not as much upfront capital, and we see returns faster. And so I'll explain that a little bit more in a few more slides. But anyways, 40 square mile grid here that we're a part of. So the game plan would be to drill the 2 best locations, then move to the 3rd, and then this opens up opportunities for a bunch of offset wells that we have the opportunity to participate in. If everything's going the way we want it, then I would assume that we would all want to participate. If not, then we cannot participate. Another situation here is some of these larger operators in the area, one in particular, BP, which is British Petroleum, is pretty active in this area. And if they start to see that we are seeing pretty decent success in this opportunity, then could be a pretty large payout with BP wanting to maybe come in and buy this whole opportunity back from Atoka, of which we are a partner in. So again, a lot of opportunity down here, a lot of historical production. We utilize, Atoka kind of looked at what's called the flipper field. And again, there's a lot of data points out there. I think Austin said that they, looked at about 30 wells that were kind of scattered throughout where this little area is, to kind of figure out the ideal location. I also want to make note that Atoka, who's the operator of record, which means that they're actually going to be the ones that are doing the drilling and development. We are a non-operated, that's non-op, we're not the one operating. We are participating into this opportunity. Atoka is the operator. So we're basically a partner in this deal. And then I took our interest and I broke it out to our investor base in $120,000 pieces is kind of how I've kind of broken that out. But what Atoka has done is they utilized some very, I would say, high-tech seismic through a company called Apex, called ADF, to really pinpoint where the formation highs and lows are. And it just, when they layered this seismic technology, and how seismic is done is they put all these trucks go out and they kind of square up and do a grid on an area, and they start kind of thumping on the ground with these big thumpers, and then it sends seismic down and back up, and they can kind of start to put together a 3D image of what it looks like under the ground on where oil and gas are located. And when you do that, that's great. But when you add in this ADF component technology on top of that, it really lights up where hydrocarbons are like a Christmas tree. So you can really see where these pockets are to, again, go in and extract the oil to make sure that you're right on top of it. And so we've spent quite a bit of money, or Atoka spent quite a bit of money doing this with Apex and ADF. So again, top of the line technology. We've got a great operator. I'll talk a little bit more about them and my family's history with them. Again, that's a big component in this deal is having an operator that you know and you trust. And so definitely have that with Atoka. So phase one is going to be drilling the 10-mile #1 well and the Barracuda. You can see if I kind of look in here, this is the river. The 10-mile is the opportunity down at the bottom right, and then the Barracuda is just above it, and you've got the flipper field in the middle that really these guys are kind of using as offsets. The flipper field is kind of spread out all over, but that's kind of where the focal point was. So they've kind of found, as you can see, they're kind of flanking around known production data to develop and put in their, I'm going to say, 2 to 3 best ideal locations based on the seismic that they received. And this is down in, I thought I'd also mention JASPO, where the name JASPO come from. We're in Jasper, Texas, so we're Gulf Coast, almost over there by Louisiana. And it was a seismic shoot that was spread over Jasper, Texas, which is a county, and Orange County. So Jasper and Orange, JASPO, there you go. So here's the development program that we're going to be looking at doing. Again, we've got de-risk development. What this means is we're not just going out and wildcatting. We're not going out and just saying, you know what, we think there's oil and natural gas out in this particular area, and we're going to start poking holes in the ground until we find it. That is not de-risked. De-risked is we're utilizing proven data points, proven production in that area, and then layering in seismic technology to then determine where we think pockets of oil may have been pushed or are currently sitting that haven't been produced. Atoka's got a very proactive approach. 40 square miles, we've talked about that. They've identified the optimum spots, drill sites to drill. Again, those are the first 2 or 3 that we're looking at. And then from there, once we kind of prove that up, then we can kind of start stepping outside of that ever so bit and to go into some of these other areas that could be, anywhere from half a mile to a mile from that existing location. So, talking to Austin Heap over at Atoka, he said that there's an opportunity for probably another 15 to 20 wells behind this. And again, this is kind of the start of that. So pretty exciting opportunity to get into. And then a scalable project. As I mentioned, we're in 40 square miles of an AMI. So part of our agreement with Atoka is we get right of first refusal into these additional opportunities. So things are going great. We can continue to play along. All right, let me see what's going on here. All right, so let's talk a little bit about Atoka. Just quick backstory. Scott Heap is the founder of Atoka, and Scott and my father, Jim Graham, were actually directly worked together back in the 70s. Scott was the reservoir engineer that did all the reserve work for my father's, I'd say his first pretty big discovery field in Rising Star, Texas, somewhere around Central Texas, back in 1976, 1977, called the Blind Hog Field. And my dad was pretty funny guy and kind of said, hey, even a blind hog will stumble around and find an acorn. So they called it the blind hog field, and Scott Heap worked directly with my dad and did the engineering work on it. So that field is still out there today producing. So it's pretty cool, kind of reminiscing with Scott and his son, Austin, who's about my age, on kind of collaborating on this type of opportunity. Unfortunately, my father passed away in 2019, but I know he's up there smiling that we're kind of working with Atoka and getting the band back together, so to speak. But anyways, I won't go through all of this. I just want to show that Atoka, these guys are approved. They know what they're doing. Being an independent operator is meaning that they're not publicly traded. They're not backed by private equity. They go out and raise capital. Just obviously they're coming to us. We're taking a piece of it. So in order to have a track record this long, you got to have a lot more wins than losses. And Atoka has a proven track record, led by Scott Heap. His son Austin Heap did a lot of work. Worked with Devon, which is a very reputable publicly traded company out of Oklahoma City, and Austin was on the engineering side, completion side, and so started there, and then ended up hooking up with his dad a few years ago, and they have since kind of really started taking it to the next level. So here's just kind of a little breakdown on them. I mean, some of these 309% annual internal rate over 8 years, 20 times rate of return, 59.9 internal rate of return on the Ains field. And so these guys 6.5 times return on investment in the Dornick Hills midstream opportunity. So when I speak to their track record, I know we got a group here, and this is one of the main reasons why we ended up taking a piece of this deal. I've looked and reviewed a lot of these types of opportunities and passed on every single one of them. I just didn't like the deal. Didn't like the operator. Some of these operators out there will double the cost on what it costs to drill these wells. So they're going to make money if it's a dry hole or not. That is not the case with our team over at Atoka. And, just with our family track record and whatnot and history with them, I know we got a good group there that we know and we trust and is going to do a good job for us. So, and they're also invested in the deal. And, they're out there with their investors raising, we're taking 12.5% of this deal, and they've got another 87.5% that they're actively participating in, as well as raising capital on from their kind of inner circle. So again, this deal you're not going to see this deal out on the market. We're kind of got the exclusivity, kind of bringing it out to our investors and kind of the broader audience that has expressed an interest through like Horizon Trust and the self-directed IRA and whatnot. So investment projections. This is, a little chart here that kind of explains cost. Again, for those that were looking at this opportunity a month ago, it was initially a 3-well project. It is now a 2-well with the right to participate in the 3rd well. And so I will be sending out some updates to those investors that have already invested with us. Again, nothing changed. In fact, the return profile actually looks better because there's less capital in play on the front end and returns start coming faster. So internal rates of return are a tad bit higher than with the 3-well. And plus it also allows us to, if the first and second well aren't up to par, then obviously there's not an investment into a 3rd well. So, so we like that, but again, return on investment in the 4-to-1 return, internal rates just really high, especially in the first 72 months. About 5-to-1 on the total. So this is back to the partnership. So I'll be sending out an updated chart here, what that looks like, kind of net back to our investor base with our promote on it. It's about a 3-to-1 in the first 72 months. But again, you can see here a payout occurs within 14 to 15 months. So we expect to be getting our money back very quickly as these wells come online. And so kind of as far as timing's concerned, talking to Atoka, they explained to me that they got rig ready to go, permits are filed, and everything's teed up. They've done the groundwork on the pad sites, and as soon as they cash call us, and we're kind of one of the last groups that they're waiting on, they will then engage with the rig, the drilling company, and they'll be out on location within 20 to 30 days after that. So I'm just kind of high level guesstimating we'll be cash called at the end of September, and then first rig will show up by end of October. It'll take anywhere from 15 to 20 days to drill and complete the first well, and then they'll put it online, meaning that they hook it up to either tank battery for oil or a pipeline for natural gas, and then they'll start first sales. So best case scenario, we should start seeing checks by January, February of 2024 on the first well, and then the second well will come on a month after. But as far as the write-off that I'll speak to in a minute, we can take that write-off in the first year when the work's done. So we expect to have all the drilling and of the 2 wells done in the first year, meaning that we can take the write-off in the first year. So ordinary income that's been accumulated this year, you can look at that as taking the write-off there. But again, all this kind of steps through. The green line is the cumulative net revenue minus the taxes and the lease operating expenses to the operator. And then kind of this blue line is kind of the total cost. So you can see, well 1, well 2, and then it kind of stays there. So that's the investment. And then, and this is the total investment for the entire JASPO opportunity. But not net to us, but the entire opportunity as a whole, the 2 wells. And so again, very strong return profile. We've had Haas engineering firm look at this investment projections as well as just the overall project as a whole. Haas does all of our third-party reservoir engineering work as well as underwriting on our mineral deals, but they also kind of look at drilling opportunities for groups like us. And overall, their report came back positive. I'm sure they just said, listen, if these guys, have 2 bad wells and hit only one of them, you and your investors should get all your money back just from the production off the 1 well. Now, obviously, that's not what we're going for, but that, from my vantage point, that's when I decided to bring it out to our investor base. So just trying to, again, mitigate as much of the risk as possible. We've de-risked the area, or Atoka's de-risked it. So, and then on the higher side, Haas could get behind about a 50% internal rate of return profile. So again, they did a lot of underwriting with the seismic technology company and to see if that was all, lining up and looking at all the production of the offsets. And so overall, I'd say a positive report for a drilling opportunity. Let's step into the tax benefits, and I'm almost done. We can open it up for some questions at the end here. Again, you've got phenomenal tax write-offs. You see a lot of these, I won't say a lot, but you see these types of drilling opportunities. Just be careful. If you get one of those, I'm happy to look at it, kind of give you my thoughts on it. But towards the end of the year, just because of the massive tax write-off, up to 75%. Again, it kind of depends on how the operator classifies certain expenses associated with the project. So the intangible drilling cost, which are, it's the cost to, the drilling rig, the fuel, all those types of things that aren't actually hard. So like the pipe and the pump jack and all that kind of stuff, that's tangible. Intangible is everything else. The fracking, but we're not fracking on this deal, but the completion, any of that stuff is what we call intangible. And that can be anywhere from 70 to 80% of the project cost are what we call intangible drilling cost. And we're able to write that off in the first 12 months, so in the first year. And so, again, very strong tax opportunity here. If you got ordinary income that you want to offset some taxes with, you can utilize this. So 100,000 in ordinary income, you invest in 100,000 in this deal, you can write $75,000 off in the first year. So again, we don't really factor any of that stuff into the economics, but it probably should be at some point. Again, consult your tax experts. I know what most of them would say that are familiar with oil and gas, as far as the IDC write-off. We are kind of reworking some of our initial agreements in place. So again, for the folks that are on the call that are already invested, we're still able to kind of adjust some things to ensure that you receive that tax write-off, to make sure that our LLC agreement is written in a way that the IRS says thumbs up on that. And so be on the lookout. We'll be sending kind of an updated letter on that, so that everything is copacetic on that front. Again, we just want to make sure that I've had 2 different CPAs and oil and gas attorneys just review and bless the agreements to make sure that we're able to take those write-offs without any issues down the road. So be on the lookout for that here in the coming week. Real quick, we'll just talk about the fund at a glance. $2 million non-operated drilling fund, $120,000 unit, $60,000 half units are available. We are roughly 1.3 million of raised cash, and then investments, and then another, I'd say probably 400,000 in committed. Some of you are on the call now, and I'm happy to visit with you about it if it's something of interest. If it is, great. If not, no big deal. So we've extended the closing date to September 30th based on what Atoka has told us based on their drilling plan. So we did get an extra month. It was at the end of August. We have extended that 30 days. Our promote on the deal as the sponsor, 25% reversionary interest. What that means is after you get all your money back, we back in for 25% after that. So every dollar after you get 100% of your investment back, we get 25 cents. And so it's a very reasonable, and I would say old school promote that my old man would do, called a third for a quarter. And so we've kind of carried that with not only our mineral funds, but also this drilling deal. We got $1,000 per month as far as ongoing management. We'll be receiving joint interest billings from the operator and processing those and all that, and doing distributions. And then there's a 3% deal origination fee. Monthly distributions will go on with this. 2-well opportunity development, so the Barracuda and the Riverbend wells, plus the 10 Mile, and which will be shortly thereafter. And then 18-month payout, anticipated 120% plus internal rate of return. Again, these are all the projections, 3-to-1, 72 months, 4-to-1 total. And then up to 75% write-off on the entire investment in the first year. Something I also will speak to here is, some of you have had access to our investor portal. Again, I will share those links here after this webinar, as far as how you can get in and kind of get access to any of the offering materials and whatnot. So again, we're looking at kind of wrapping up the capital raise here by the end of the month here. So hopefully, if you have some questions or whatnot that you don't get answered on this call, let's schedule a call and go over that stuff, see if this is something that you'd be interested in. Again, part of our growth strategy at Rising Phoenix, we will be rolling out our next income fund in October. Again, that's with the producing minerals, but this one's exciting, I think, just because of the kind of the upside. Again, we mitigated as much of the risk as possible. We got a good operator at the helm, and we got all this phenomenal tax write-off onto ordinary income. If you want to reach out to us, Abby Wilson, new business development. So excited to have her on the team here at Rising Phoenix Capital. Here's some contact information, 214-833-9920, and you can send an email to invest@rising-phoenix.com. Again, we will reach back out after this, shoot you some links. Again, we can send a copy, a link to this recording if you want to rewatch any of that. And I will leave it at that. I think we're almost 40 minutes in. So I respect your time, but if anybody has any questions, feel free to put them in the chat, and we will kind of open that up. Somebody asked if we will be recording the presentation. We will be. Any other questions that may come up, feel free to post those, and if not, then the chat is disabled. Interesting. Okay, let me see. I can see your chat. I should. I can see the chat, but this is Q&A. Oh, there you go. Sorry about that. So Q&A. If you have a question, you can put it in the Q&A. Thank you. And I'm happy to help. Got a question from Scott. Jace, when you say potentially write off up to 75% of the intangible costs, what is potential? Again, the reason why I'm kind of giving a little bit of a range here is it's really going to be dependent on what ATOCA classifies as intangible drilling cost. So they've got, all these costs going on, and they're going to say, tangible, intangible, tangible, intangible. And just looking at enough of these deals and actually talking to ATOCA themselves about this, they have mentioned that it's going to be probably closer to 80%, but I just like to say 75 just to be safe. So 70 to 80% tax write-off that you can apply towards ordinary income on your tax return. But good question. All right. Let me know if we got any other questions. I'll probably hold it open for another minute or so. Again, trying to be respectful of your time. All right. Well, guys, if you do have any questions and you want to speak to me directly, I will send out a link. You can schedule, we can get on a 15-20 minute call, answer any questions you may have. Again, excited about this opportunity. I'm invested in it, obviously. My family's invested in it. Take that pretty serious. Got some good friends in this deal. And again, just trying to expand our kind of investments to our circle of friends and family and folks that are kind of being referred to us. So we're not out doing a lot of blasting and marketing. It's been growing through word of mouth organically, which has been pretty cool. So I appreciate you guys taking the time out of your day on Tuesday. And again, if you have any questions, feel free to reach out to me direct, and we will chat soon. Appreciate it.